If you had $100,000 to invest, where would you put it to maximize its growth? Would you choose the active management and expertise of a mutual fund, or the flexibility and cost efficiency of an ETF? It sounds simple, but this choice could mean the difference between millions in your future or leaving money on the table. So which one delivers more? In this video, I'll show you the difference between the two and what's best for you and John. I've also chosen two standout options, a top-tier mutual fund and a growth-focused ETF. In the end, I'll show you and John a side-by-side comparison of the two and see which one will return the most on your investment. And the difference is significant, over $2 million. Let's start by understanding what ETFs and mutual funds are. ETFs are a basket of securities that you can buy or sell on a stock exchange. Just like individual stocks, they typically track a specific index, sector, or asset class and are known for their flexibility and low cost. On the other hand, mutual funds pool money from many investors to purchase a broad range of assets, managed by professional portfolio managers who aim to outperform the market or track a particular index. Now, one of the first things you'd notice when comparing ETFs and mutual funds is the way they're structured and traded. ETFs are bought and sold like stocks, meaning they can be traded throughout the day on the stock market. This flexibility allows you to respond to market movements instantly, which can be a huge advantage for those who want more control over their investments. But in the case of mutual funds, they are priced at the end of each trading day based on the net asset value, which is the fund's per share market value. This means that regardless of what happens during the day, any buy or sell orders won't be processed until after the market closes. This difference also leads us to the issue of liquidity. With ETFs, the liquidity is high because you can buy or sell them throughout the day whenever the market is open. The stock-like structure of ETFs gives them high liquidity, meaning you can enter or exit positions with ease. In the case of mutual funds, the liquidity is lower, as you can only buy or sell mutual fund shares at the end of each trading day. With mutual funds, you don't have the same level of control or real-time flexibility. Another key difference between ETFs and mutual funds comes down to fees. ETFs are generally more cost-effective because they're usually passively managed, tracking an index like the S&P 500, which reduces the need for expensive management teams. In comparison, mutual funds, especially actively managed funds, come with higher fees because they employ fund managers to pick and choose investments in an attempt to outperform the market. This difference can add up over time, so it's worth considering how much you're willing to pay for professional management. So, what's the minimum investment required for mutual funds or ETFs? Well, with ETFs, you can start investing with as little as the price of one share, which can range from just a few bucks to a couple $100 depending on the ETF. Mutual funds, on the other hand, often have minimum investment requirements that can range from a few $100s to several thousand depending on the fund. Most retail mutual funds require a minimum initial investment of between $500 to $5,000, and that can be a barrier for new investors. Okay, so now you know what ETFs and mutual funds are and how much you and John might need to invest in them, but what about the risk and return dynamics? Any discussion about investment options would not be complete without considering risk and return. And in the end, I'll show you how I use investing metrics to find ETFs or mutual funds that can turn a $100,000 investment into more than $5 million. For now, let's see what you'll have to deal with if you're considering investing in ETFs and mutual funds. The first thing you need to look at is volatility, because this will show you the potential profit you could make or the loss you could face. ETFs, since they trade throughout the day, can be more volatile in the short term. Their prices can swing significantly during the trading day, especially if you're invested in a sector-specific ETF like one that tracks technology or emerging markets. Mutual funds, on the other hand, tend to be a little less volatile because their prices are only set once at the end of the day, which means you're not as exposed to short-term market fluctuations. When it comes to performance, ETFs typically mirror the index that they track, offering steady, predictable returns. Actively managed mutual funds can sometimes outperform the market, but higher fees often reduce net returns, so you need to weigh the cost against any potential gains. Even if there's potential for good returns in either, you want to spread your risk through diversification. Both ETFs and mutual funds offer ways to diversify your portfolio. With ETFs, you can easily invest in a wide range of sectors or asset classes with just one purchase. For example, an ETF like the SPDR S&P 500 gives you exposure to 500 companies in various sectors. Mutual funds provide a similar level of diversification, but with the added benefit of professional management. For instance, investing in a Vanguard Total Stock Market Fund offers exposure to U.S. stocks across all market caps, while the fund manager handles the day-to-day decisions. But what the manager does not handle, and is entirely up to you, is understanding the tax efficiency of your investment. Taxes can erode a significant portion of your returns, so understanding how ETFs and mutual funds stack up in this area is crucial. Both types of funds have different tax treatments, which can have a big impact on your overall investment returns over time. So let's break it down. ETFs are generally more tax efficient due to their in-kind creation and redemption process, where shares are traded on the open market without triggering capital gains taxes. You only pay taxes when you sell your ETF shares, making them ideal for a buy and hold strategy. For example, the Vanguard S&P 500 ETF avoids internal transactions that generate taxable capital gains unless the index changes. Mutual funds, however, are less tax efficient. Actively managed funds involve frequent buying and selling of securities, which triggers capital gains. These gains are distributed to investors who must pay taxes even if they haven't sold their shares. For instance, holding shares in the Fidelity Contra Fund could result in unexpected taxable gains due to the manager's trading activity. This structure can lead to higher taxable income for investors, especially if the mutual fund has been actively buying and selling stocks throughout the year. In comparison, ETFs typically only incur taxes when you sell your shares, making them a more tax-friendly option for a buy and hold strategy. ETFs are ideal for active investors due to their flexibility to trade throughout the day and their tax efficiency, which allows you to control when gains are realized. They also provide easy access to niche markets, like the iShares Global Clean Energy ETF, offering diversification without picking any individual stocks. Mutual funds, however, are better for regular contributions, such as dollar-cost averaging or retirement plans, since they allow fractional shares, ensuring every dollar is invested. They're also a good choice when niche ETFs have low trading volumes, as mutual funds avoid liquidity issues by being priced once daily at their net asset value. In the end, I'll show you and John a side-by-side comparison of the two and see which one will return the most on your investment. And the difference is significant, over $2 million. Now that you and John understand the basics of ETFs and mutual funds, let's take a closer look at two specific options that I've chosen for this comparison. The Fidelity Advisor Technology Fund, a mutual fund, and the Invesco S&P 500 GARP ETF. I picked these two because they both focus on growth investing, yet they represent different approaches, actively managed versus passively managed, which makes for a fair and insightful comparison. By examining their performance, you'll see how each option can grow your $100,000 investment over time. Both of these funds target sectors or strategies that emphasize long-term capital appreciation. The Fidelity Advisor Technology Fund is an actively managed mutual fund that invests in high-growth technology companies with professional managers hand-picking stocks they believe will outperform the market. On the other hand, the Invesco S&P 500 GARP ETF follows a passive approach, tracking companies within the S&P 500 that show growth at a reasonable price, GARP, a strategy balancing growth potential with valuation. Starting with the Fidelity Advisor Technology Fund. This mutual fund has a dividend yield of 1.2%, which has been growing by 6.85% over the years, and it has a share price appreciation of 11.51%. Based on these metrics, if you and John invest $100,000 in this mutual fund, after just 1 year, your portfolio would grow to $112,710. Over the next decade, the value would increase significantly to $324,361, driven by strong returns in the technology sector. By the 20-year mark, the portfolio would reach $1,017,930. Finally, after 30 years, the investment value would rise to an impressive $3,129,575, with $8,417 in annual dividend income. The total value added to your portfolio over 30 years would be $3,029,575, with $2,915,399 in capital appreciation and $2,915,399 in reinvested dividends. In comparison, the Invesco S&P 500 GARP ETF delivers even stronger growth. It has a dividend yield of 1.32%, backed by a strong dividend growth rate of 11.27% over the years, and it has a share price appreciation of 13.13%. Based on these metrics, if you and John invest $100,000 in this ETF, after 1 year, your investment would reach $114,450. By year 10, the portfolio value climbs to $382,089. Give it 10 more years, and at the 20-year mark, the investment grows to $1,433,585. After 30 years, the portfolio value reaches an outstanding $5,298,091, with $35,622 in annual dividend income. The total value added to your portfolio over 30 years comes to $5,198,091, with $4,873,451 in capital appreciation and $323,640 in reinvested dividends. If you compare both projections, you can see a clear advantage for the Invesco S&P 500 GARP ETF over the Fidelity Advisor Technology Fund when it comes to long-term growth. While both options deliver impressive returns, the ETF's stronger capital appreciation and lower costs result in a significantly higher final portfolio value, $5.29 million versus $3.13 million over 30 years. This shows that the actively managed mutual fund, despite strong returns, is held back by higher fees and potentially less efficient growth. Want to know how to turn a $30 weekly investment into a portfolio that pays over $5,000 in monthly income? Click the video on the screen.